Hello, hello, hello. Brian, now any better? Oh, Brian's gone. So let's, Nicole, you're still here. Is it? I can hear you now. Okay, okay, okay. I don't know. It was plugged in. It wasn't muted. I guess it needed just an update or something. Unfortunately, we missed Brian because of that reason. Hopefully he's back. It went silent for a couple of minutes. Okay, so it wasn't the entire time. Okay, okay, good to know, good to know. So, as I was saying, welcome everyone. Before I officially start, as usual, I would like to confirm. Okay, actually, I did confirm it with Nicole just now, the audio. Uh, as you know, webinars@edgefm.com is our email address, and I'm trying to reply as soon as possible. Oh, Brian is back. Good. I thought I lost you due to the audio. Yeah, I just unplugged it and plugged that in. Again, I don't know what went wrong over there. Literally no idea why I wasn't capturing sound. So, need to go through the disclaimer warning team, and after that we can start. So, this material is provided as general market communication for information purposes only and does not constitute independent investment research. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as Forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, take into account your investment objectives and level of experience before trading, and if necessary, seek investment advice. Please read our full risk disclosure. Okay, admin is out of the way. Okay. What we're gonna do, what we're gonna see today. First of all, we need to understand what risk and money management are and why they are so vital, so critical. So what's the difference as well between risk and money management? And how, by using these two concepts, um, how it affects a potential, let's say, success or failure. Also, risk and money management, as I mentioned earlier, should be used in a strict. So that's why I said that it might be at the very, very first number one in level of importance. It might be the number one along with the proper mindset. Okay, so it's it's strongly correlated with a proper mindset, and only with a combination of a proper mindset can be useful. Okay, so and beneficiary as well. This is what matters the most, right? So first of all, let's understand why we lose. Okay, why we lose? Uh, why we lose in the markets? Why we lose in trading? Okay, there are many reasons for that. These are four of the most key ones. Okay, four of the most important ones. So first of all, too little capital. So what I mean by that there is no correlation, or actually there is an over ambitious. Um, will we get this handout? Oh, sorry. Yes. Yes, yes, yes. Just a second. Just a second. On it right now, Nicole. Okay, they are on. You can take over it right now. Okay? Okay. So, as I was saying, no, don't change, go back. Actually, okay, yeah, as I said, the very first is too little capital, okay, and over ambitious. What we mean by that? Having either having too little or too much in your account, okay, can can pose a problem. You might think that I'm crazy, I know that, but it's a matter of psychology as well, and a matter of reasonable targets. Okay, what I mean by that, having, I don't know, five, $10, $20, but aiming to get back, I don't know, uh, 3 times more than that is not logical, is not feasible. Okay, so usually small capital balances can result in trades being taken that are too much percentage of your total balance, excessive risk. So having having small capital is okay, it's okay, but with an appropriate risk and reward ratio and a reasonable um, return back. What I mean, if you have invested just $5, let's say, and you want to gain 15, then you're not back in reality. You're not in down to earth, let's say. Okay, with this way, it can be done, right? It can be done, but with this way, you are risking, in order to achieve something like that, okay, and triple your money, let's say, you are you have or and you you're doing an excessive risk, because you are to achieve what you thought it was a good idea or something, you're risking the full amount of your balance, everything that you have invested, in order to gain back 3 times, 4 times, 5 times of what you invested. So this leads to an excessive risk, not a reasonable. It's not a reasonable risk management. The same stands for. Let's get back to the table. Okay, let's get back when you are okay. When you are um, when you are over trading as well, okay, the anxiety, the greediness sometimes, the impatience sometimes, okay, leads to over trading. Oh, I want to take to get to have at least in my account to get back a profit of I don't know, 1,000. And that's not the correct mindset, because it's emotional driver. Okay, so over trading is also something that leads to it could lead to a failure. And actually it might be yeah, it's equally one of the reasons that they lose, they of the reasons that lead to failure. Okay, because at the end, it's like you don't know yourself. You cannot control yourself. So either by too little capital, in which you will have uh, to um, use the full amount of your capital uh, to trade, and with this way that leads to an excessive risk and a really really high risk of losing the full capital. Either, which is what I said earlier, the too much risk, excessive risk because of a little capital. Or sometimes some people, they have an appropriate capital, they have a not too little, I mean a sufficient enough capital, but because they are not patient enough, they are all greedy or whatever the reason, they don't consider an appropriate percentage of risk, so they have the risk level is way too high. So 30% risk is enormous. It's enormous. Theory says, not only theories, actually experienced traders, and also the experience is saying that there is should be less than 5%, less than 3% sometimes. Okay, little until you get uh, until you get confident enough. I'm not saying that once you're confident, once you are experienced, you will reach 30, you will set back to the 30 minutes, 30% risk. No, 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 not even the huge, the big hedge funds players, or I don't know, institutional players are not having a 30% risk in their trades. Okay, you can tell them, but they trade millions. They trade, yeah, yeah, exactly. They will not lose. They will not risk, not even the 5% of their capital. Okay, but as I said, knowing yourself is a priority. Knowing yourself as a person, knowing your weaknesses, knowing your strengths, knowing having some acknowledgement of your limits, it's key, not only in trading, but in every single business, in general in life. Okay? Trying to use any weakness that you have on your benefit, because by acknowledge your weakness, let's say, yeah, that you recognize that, I don't know, that you have the habit of risking too much, okay, of not being able to control your greediness. By being aware and acknowledge this weakness on you, that will be the very first step in order to control it. You need to think about, okay, I know that, how can I control it? What mechanism can I use in order to control this weakness? So acknowledgement is the number one. Okay, but other than acknowledge of the weakness and strength of the mindset, the emotions, it's also good, not good, but one of the main reasons of a failure is also not knowing yourself as a trader, and I'm referring to not being aware where you are good at. So having a setup for a particular with a particular indicators that you understand, and the particular time frame as well, because it's not like everything is working for every one of us. No, Brian might be good as a day trader, Nicole might be good as a scalper, so why not 5 minutes chart? So you need to find out where you are good at. by testing, by putting, testing all the time your indicators, figuring out, finding a system for a particular time frame as well. So let's move on. So yeah, these are the reasons for that could lead, and actually traditionally lead to losses. You need to identify yourself. You need to understand what kind of trader you are and what kind of weakness you have as a character. So never, 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 never risk funds you cannot afford to lose. So as we keep saying, the amount of money that you should risk, it will be the amount of money that you are okay losing. So what I mean by that, you need to ask yourself, okay, you are aware of how much salary you're gaining. You are aware of how much savings you are able to save every day or every week, every month. You are aware of your expenses every month, right? So put everything down and say, okay, I can risk that X amount of money every day. So it might be 50 euros, it might be, I don't know, 10 euros. You need to figure out how much you are okay losing. Okay? Well, you can say to me, why, Andrea? It's like I'm taking for granted that I'm gonna lose. No, you're not taking for granted that you're gonna lose. But by figuring out how much you will feel okay losing, then this will help you with your emotional control, because it's not like you can, markets are moving up, down, sideways. Okay, indeed, an appropriate strategy, risk management, money management, they will help us and they will increase our chances to succeed, right? But something might happen, the trend turns against us. So we need to have an appropriate level of stop loss, that we are okay with it, that will not blow out our account, and that we will be okay losing. We'll say, okay, I'm okay, that the day went bad, but I'm okay. I will start again tomorrow. I didn't lose much. I lost as much as I was okay losing. I think you are getting my point, right? So yeah, it's you need to figure out an appropriate level at which you can afford to losing. Okay. Starting with a too high initial capital may result in a lack of respect for your capital and taking more undisciplined trades. So what I mean by that, if you don't have a standard amount that you are okay losing, that you can afford losing, and you say, no, okay, today I decide to go long in euro dollar, and I don't know, maybe but you didn't even consider setting an appropriate stop loss at that particular trade, and you end up losing $500, for example. Okay, on your how the human brain works, unfortunately, is that once you're seeing that you're losing and losing, you might think, okay, it will reverse, so I will stay until it reverts. I'm gonna get back to, I'm gonna win, so you tend to leave your positions open, even if you have exceeded the amount you could afford losing, because you're thinking that it will get back to on your favor. Or sometimes a different mindset is we can see people like losing 500, let's say, okay, that obviously was a number that they couldn't afford losing. They say, okay, I need to recover ASAP, I need to gain that money back ASAP. So that ends up to open without doing an appropriate analysis, a lot of positions open in order to recover, going against the trend, trying to find mechanisms to act quickly without thinking. Okay, so you need to find the level at which you can afford to lose, and if you lose it, you will stop for the day. You will come back the next day with a clear head. Okay, I'm doing a bit of an emotions webinar today, but they are very strongly correlated. Like it's, yeah. So a reasonable initial capital also highly depends on whether you're a retail or institutional player. Absolutely right. Always size your account relative to your total personal equity. Risk capital should in general not present more than 20% of your net asset value. So let's move on. 5 of the most important things that you need to take into account. Sorry, I have to reply to something. Okay. Okay. Five things to take into account when determining the risk levels in trading, in Forex, in general. Number 1, leverage. Okay. Leverage. Find out so before actually you take before you decide what you're gonna do and etc. You need to be aware of the leverage rate, because okay, leverage varies depending on the instrument, right? On the account type as well. So the very first thing that you need to spot and be aware of is the leverage, because there are a variety of account types and actually also a huge gamma of instruments, right? So each one of them is different. It's different. So you need to be aware the leverage before you take any decision. Why is moving up, down? Sorry. What happened here? Sorry, just a second. Okay. Second, that's something that we already covered. Basically, the second, the third, and the fourth are things that we have already covered. Thank you, Philippus. Thank you. So risk and reward ratio per trade, max percentage exposure, correlation risk. Okay, fourth we haven't covered, but mainly the second and the third we did already partially covered verbally at least. Okay, so remember that for each one of us, right, of you guys as traders, for each individual person, risk and reward ratio is different. It has to do with the risk appetite, right? But you need to keep your risk and reward ratio at a reasonable levels, such as to double your money. So to basically profit double of what you risk, or to profit 3 times more of what you risk, or sometimes I can say 1 to 4 as well. So, but keep your risk ratio at the reasonable levels, especially the risk one. Don't open trades without considering whether the amount that you're risking are much less than the amount that you will reward. Because sometimes without, actually, the new traders especially, they don't use stop loss and etc. So they are basically, what that means, they are risking the full balance, the full balance of their the full amount, basically the full account, just in a single trade. So this is I don't know how to call it. I mean, I don't want to call it stupid, but it's like you're searching for troubles, basically. So set in advance a risk and reward ratio per trade. Say, okay, based on my analysis, I have found these resistance levels, these support levels, the amount that I want to risk, and the amount of money that I want to risk in this single trade are this much. So let's assume that you have 1,000 in your account, and you want to open a trade, I don't know, in Aussie. How much you want to risk in Aussie in just a single trade? You might say that, okay, I'm good on risking 100. Okay, that's way a bit high because it's 10% of your account, but fair enough. Okay, that you are willing to risk 100. So what would be your risk and reward ratio? That means that it would be 1 to 2, 1 to 3, 1 to 4, or, and etc. So if you're thinking 1 to 3, for example, it means that you want to gain back 3 times more than the 100 that you are risking. Okay, so you need to set it in advance and stick to it. Don't change it because you might see a pullback or the asset turning against you at some point. No, stick to what you have decided before you're you open the position. So put your stop loss at a level at which that will be equal with the $100 of risk that you decided. Max percentage exposure. Actually, these are things that ideally in your trading plan are things that you should decide in advance and stick to it for in general. So you need to, in your trading plan, you need to say, okay, every day I don't want to open more than 5 trades a day. I don't want, so you are setting some limits for yourself, some limitations of your own self. So you need to set some parameters in order to not to let your emotions drive to all those mistakes that we mentioned earlier, the overtrade, the high percentage of exposure, etc. So you need to set some rules, some restrictions that, okay, every day I don't want to risk more than $100 in general, in total. Also, I don't want to open more than 5 trades every day. So once you put the criteria down, let's say you open the 5 trades, also why not also so once you open the trades and you have set your goals and etc. Once you're done for the day, once you complete all the 5 trades that you have as a parameter, you need to stop. Even if you're in benefit, even if you have double, triple, or whatever your the money that you risk, you need to stop because this will give you discipline and come back the next day, okay, for another 5 trades and etc. You need to follow your plan. You need to follow the parameters that you have that you have set for yourself. Otherwise, you will not have discipline, and if something ends up badly, at the end of the day, you will um, uh, being pushed to possibly rushed rushed moves, and that's not a good that's not good because we're like in a rush to break even, or or I don't know, reverse some losses and etc. We don't have a clear head, and we end up like possibly losing more. So stop, even if all your 5 trades were ended badly. Stop, since you complete your 5 trades. Come back the next day with a clear head and calmness to start again. Smiling, Nicole says, smiling at this end because I had a wonderful trading plan. The issue was me. Discovered that my knowledge of money slash risk was not much for what I wanted. Meant going within to explore some things. Discipline didn't hold all because of money stuff, all programming that needed to be rewritten with new understanding of money. So what was the main what was actually what weakness you spotted, Nicole? It would be very interesting for the also for every one of us, for all the participants of the webinar. You're saying that you had a wonderful trading plan, but the reason you discovered that your your knowledge of money and risk wasn't appropriate, let's say, and then discipline, as I can see, was the weakness, the greater weakness of all. So, what was the feeling? What why you're saying you didn't have discipline? So you were over trading. You were what were you were doing wrong? What the um, what really what was the reason? My lack of discipline, a lack of preparation for this business. I did everything wrong at some point. So you were like angry, you got impatient. When you were losing, what was the feeling that led to possibly wrong decisions or over trading, or I don't know? I didn't trust myself. Remani and couldn't understand why. Nice. Nice. Yeah. You know what? It's you are on the right path. And why I'm saying that is because it's what I said earlier. You are aware of your weakness. So that's the very first step to succeed, because now you start knowing yourself, knowing your strengths and your weaknesses, and you can work on it. And that's huge. That's huge, trust me, because the majority of the people in general life, and not only in trading, in general life, we're seeing people around us don't be able to realize their behavior, their way of treating others, and their mistakes, not even if they're done a mistake, not even being able to accept it and to say it out loud. So being able to say out loud where you were mistaken and leave the ego behind, it's important. It means that you are you how can I say that? I'm trying to find the correct. It's ego big time. Yes, it's a big deal, and being able to understand it and to spot it on you is it might be you might be a breath away from from solving it. The key is to understand it. So that's a big struggle. So the fact that you are telling all this to us, it means to me that you're at the correct path. Not only the correct path, actually, you're a breath away on succeeding because you understood what gave you actually your own self put some barriers for you to succeed. And now that you have understood what these barriers are, you can take them down and proceed. It is not an overnight work, but I'm working on it in small steps to establish. Well done, well done, well done, bravo. I'm still working on myself as well, and that's the most important. And something is a work is something that we shouldn't stop doing. I mean, it's not like it's something easy and can be not done. Yeah, as you said, overnight. No, the more that we invest in ourselves, the more promising the future will be, and the more the more goods the future will give us. Actually, guys, okay, work on yourself. You might thinking that, oh, this webinar ended up in a psychological one and not a trading one, but it is key for every single business, for everything that you do in life, everything. Okay, let's get back to let's continue. Correlation risk, event risk. So sometimes, not sometimes, actually, an example about correlation risk is the obvious: oil and Canadian dollar, gold and dollar itself, stocks and bonds. Is okay. We cover a lot about discipline, about emotions, about the risk management, etc. But it's also a matter of correlation risk. If your asset is strongly correlated with something else that is on the current affairs right now, so for example, oil, due to the Israel and Hamas conflict, we are seeing that this conflict, this escalation of geopolitics, this escalation in the Middle East is something that affects significantly commodity asset and safe haven demand as well. So, and one of all, I mean, not safe haven, but commodities, and one of something that is strongly correlated with the conflict is oil as well. So that's why once you decide at some point, because I don't know, something triggered your attention, you want to open a trade on Canadian dollar, you need to think about the correlation with oil, or even open a correlation metrics, which anyway it's on your platforms, and check what's the correlation level within the day, within the last hour, and so on and so forth. So correlation metrics, and check the correlation. What's going on between dollar, CAD, and what is my oil, for example, and oil in a 1 hour chart. So the correlation here is a bit neutral. So nah, not a really correlation. So okay, you can ignore it then. But if you're gonna about to open a trade and daily, you're a day trader and you are considering to let's say, I don't know, let's find if you are thinking to open a position in CAD yen, which has a negative correlation by 80% with gold, yes, you need to think about it. So it's good to have also correlation metrics at some point at the back of your head to double check it before you take your position. Obviously, event risk. Okay, I won't repeat it. I will say with a single sentence. The very first thing that you need to do every morning is check your calendar. What's the upcoming events? Okay, so thank you, Nicole. Thank you. You're absolutely right, and your testimonial, I will say, the fact that you told to all of us here in this session, your experience is very helpful, because I'm sure that a lot of people felt the same way, and including myself as well. By the way, I'm not taking myself out of the way. It's very important in sharing these common experiences as well. Okay. Another thing I mentioned, no, actually, it's not another thing. Is rephrased, let's say, because before we said it, we said that we have leverage, then risk and reward ratio per trade, right? But risk and reward ratio and the percentage expenditure is all about following your plan and setting goals. Setting goals. This is the risk and reward ratio. This is the percentage exposure. Okay, this in practice is the one, setting goals and stick to it. So as I said, actually we pretty much, but I have it in an illustration over here with a very old 2017 example, since I'm here in HFM as a market analyst since 2017. So at the end of the year, I'm gonna celebrate my my 7 years here, actually in January 2024. So yeah, setting realistic target risk and reward ratio exposure. So this is an example of a 1 to 2 risk and reward ratio. Okay, so okay, daily chart, we spotted a key resistance here at the previous swing high. The asset planked down, broken this immediate support level over here, extended lower and posted a new low, and since then it moved higher, right? A nice decisive bullish candle, another bullish one with a long tail lower but no tail at the top. So that indicates that bulls are in control, because despite the fact that bears tried to put the price lower, the bulls managed to get it higher and close at the highest level. Thank you very much, Nicole. Thank you very much. A doji one, right? A doji one, and so we could see that this an appetite to the upside. So the next immediate resistance after this swing high over here, it was this repeated ceiling over here. The latest swing high was here. So, and the round number as well. So someone is thinking, okay, if the asset, so we remain to see whether the asset will pull back up or whether it will continue to the upside path. If it continues to the upside, a potential entry will be the 48 level, latest swing and resistance level, but also a round number, right? So that would be an ideal entry point with the previous swing high as the very first next target area. And here it is. So entry at 48, target slightly above this swing high, just because it was just a breath above 49 level, right? And stop loss at 47.50. Why? Because we have predetermined that our goal, our risk and reward ratio is 1 to 2. So we want to, the parameter that we have fixed, always, never change, is 1 to 2. So we double than what you risk. So by setting the target at 49, so that's $1 higher, right? So it means that I need, in order to respect my rule, okay, because you are the ones that are gonna set the risk and reward ratio, and you want to must respect every single time, every single time. So in order to respect your rule, your goal, you need to put the risk halfway. So that means if you are risking, if you want to benefit the dollar on a dollar's move, that means that the stop loss should be 50 points below the entry level. So stop loss is at 47.50, right? a long position with entry at 48, expected with target at 49, and stop loss at 47.50. So respect it. Okay, you can. It is okay. If you have multiple targets, it is okay later on to shift higher and higher and higher your stop loss, but always in respect to the risk and reward ratio. Okay, a lot of wording, I know, but we are covering all this. Uh, we have pretty much covered it. So determine risk levels. Basically, as I said, key and number one is first of all to set your goal and stick to it for all of your trades. With an amount of money that you are willing to risk in total every day, how many trades you want to open every day, and just stick to it. Now, after you have set all these parameters, fixed parameters, in order a way to apply them on your trade is basically doing your technical analysis like we did briefly earlier with oil. I mean, find your support, resistance levels, a potential entry level. You see, so doing a technical analysis, see, okay, bring your charts on and say, okay, euro dollar here, the first resistance of the day is the high of the day. An immediate resistance is the low of the day. If it falls below the first the day low, the next support level is at the bottom of the Bollingers, and later on at yesterday's bottom. So find that, do a technical analysis first. Okay, find your support, your resistance level, check what your indicators are telling you. Are they provide any bullish, bearish signal? Are they suggest that this pullback will continue, and so on and so forth? So doing your analysis like you used to do. Okay, you used to do. So once you do that, okay, if you decide to enter a trade, a pending one or an immediate one, if you saw your asset, I mean, breaking a support or resistance level that you have predetermined and you are ready to jump in, okay, then adjust your stop loss, okay, and adjust your stop loss based on your analysis. So what I mean, actually, let's okay, for example, this is dollar index. Okay, I noticed this floor over here. Okay, I noticed that since yesterday we have that currently we are in a rebound, right? Okay, and I was thinking, okay, the first resistance, the first a support of an immediate support is the 105.62, because this is double fractal. 2 days lows over here, retested two times since Friday. So I'm thinking out loud, I can see RSI is at 49 and rising, so it's ready to break the 50 level, and it's keep rising. The slope is quite aggressive. So I was saying, okay, if it breaks the 50 Fibonacci level, it could breach this swing high and eventually get back to the 9th of October high. So I mean, doing your own technical analysis. So that means that, okay, so if I take this entry at 105.90, for example, with the target, let's say here at those double top 105 or 106, so this will be 20 18 18 sorry, yeah, 18 pips. 18 pips. So the entry from the target is 18 pips distance. So in order to respect my 1-to-2 ratio, it means that the stop loss should be halfway, so at 9 pips. So that means 9, 9, 7, 8, 9, somewhere here. So the stop loss will be somewhere here. So you can set a pending order, say, if the asset open a trade, long trade, once the asset breaks the 105.90, we target at 106.9 and stop loss at 105.80. So this is them. You need to do your technical analysis like you used to, okay? And if there is anything that triggers your attention and you want to open a trade, adjust your stop loss based on your goals and your target and your risk and reward ratio, etc., etc. Okay, so let's move on. The risk and reward ratio should not be less than 1, although depending on if you are a short-term scalper or duration trader, your risk reward levels will naturally vary depending on your appetite for volatility. Duration trades equals higher volatility, so more headroom required to the stops. So obviously, a risk and reward ratio depends on what kind of trader you are, what kind of strategy you are following, okay? A scalper has a very, very different risk and reward ratio than a day trader, than a swing trader, than a long-term trader, and so etc., okay? So also something that complies with the risk management. It's okay to change your stop loss or your trailing stop loss. That's up to you. If your position is on profit, okay. So if your position, if first of all, if you are a duration trader, so you see you have positions open for a long time, etc. When your positions are on profit, okay, to a desirable level, of course, to a level that you might have breached your goal, okay, you may wish to consider moving your stop loss higher in order to lock and ensure some gains. Let's assume, just to give me an example. Do I have an example here? No, I don't. So that's why I'm gonna bring the so for example, I don't know, okay, daily, euro dollar daily and duration trader, possibly, if someone did saw this downtrend, I will be impressed. But duration trader that spotted this long downtrend in euro dollar, okay, let's assume that he spotted it once the asset, I don't know, broken the 50% Fibonacci level, and also, and that 50% Fibonacci level was now turned to resistance that it was failing to break. So let's assume that someone enters somewhere here. Okay, somewhere here, on this level. Okay, and enter the euro dollar somewhere here with the very first initial target at this triple bottom over here. Okay, and target number 2 at the mid of the 100 and 161 territory, which also coincides just fine with May's bottom. Okay, let's assume that someone spotted this down leg and decided to enter short at 106 somewhere here at the 61.0, at the time that it was retested 1, twice, 3 times, 4 times, and it failed. So somewhere here. So this kind of trader, okay, that first of all breached its first target, which is here, this one, and having the stop loss slightly above the 50%. So if I consider this later swing and slightly above it, the stop loss should be somewhere here at 110.82. That would be a risk and reward ratio 1 to 3, around 1 to 3, 1 to 3, if I'm not mistaken. Let me measure it. Yeah, 70. No, actually it's double. Yeah, correct. It's 1 to 2, not 1 to 3. 1 to 2 ratio. Stop loss here, first stop loss here. So if the trader sees that, okay, the first target was hit and the asset resumed the decline and is approaching the second target. So you can, in this case, you can drag and drop your stop loss closer to lock some profits. So you can put it down to the latest swings or to the latest support, resistance areas. And with this way, you are locking profits. Okay? So that's fine. That's it's a part of a risk management. It's not, with this way, you are locking gains. So it's either a dynamic stop loss or a trailing stop loss. Now, let's move on. Actually, I'm gonna skip this slide because we stated we discussed it already. Ideally, and what the more experienced traders follow, and the history has telling us, the theory is telling us as well, and based on the Kelly risk management actually criterion, the um, it's good to consider the Kelly risk management that uses the historical success rate profit factor per trade to determine a risk level. Okay, so but in case that the Kelly risk management shows more than 5%, it's better to avoid it and stick to 5% and less than that. Okay. Where can you find it in our just a second, let me see whether it's so the formula is here, but if I'm not mistaken, there is a calculator in our website using Kelly's criteria, so you can use that one. So let me just try to find out to be absolutely sure. Wait. Give me a second, guys. Formula is here as well, but ideally, where is it? Let me double check. Kettler, Kelly. Where's Kelly? Calculators, trading calculators. By the way, there is this very useful risk and reward ratio a calculator in which you place your okay, here we are. Okay, you are placing your targets. Okay, well, actually your prices, not your targets. Okay, and it give you actually your price. So that takes, yeah, the very first is a downtrend. Yeah, okay. Okay, perfect, perfect, perfect. So this was updated lately. So you can actually calculate the best targets with respect to the risk and reward ratio based on the Fibonacci retracement, if you want. So have a look on this risk and reward ratio calculator as well. It might help you. And also, come on. Where is it? Sorry, guys, I had something very particular in head. So, okay, that's based on pivot points, several pivot point analysis. Hmm. Okay, just this is in case. Okay, that's also an alternative. In case if you don't want to use the Kelly's risk management formula, okay, alternatives that you can use in order to okay, Kelly, by the way, just to be clear, uh, this particular formula is pretty much it will help you to calculate what percentage of your money will be allocated uh, to every asset that you will decide to open a position at. Okay, so it's a very important system. It's a very important money management tool, let's say. Okay, but in case that you don't want to do something like that, you don't want to use this kind of formula, etc., some alternatives are the calculators that we have in online, and using some using alternatives as well. So there is percentage calculator and the risk and reward calculator that we saw earlier. Uh, so let me see whether I can find. Hmm. Okay, there are online a lot of Kelly criterion calculators, automatic ones. So yeah, so you can use one of those if you want, obviously. It's just one way to do it. That's up to you. Now, what else? Okay, yes, it's about correlation. As I told you, you need to be aware of any significant strong correlations that your the asset that you want to take a position on, might have, okay? Especially if you are about to open multiple trades at the same time, okay? So, for example, having a long dollar Swiss and a short euro dollar poses correlation risk because they are correlated, inversely correlated. So keep an eye on the correlations, whether they're positively correlated, negative correlated, and etc. Also, it is recommended to short-term or scalp traders. I don't know how many of you you belong to these groups that majors are useful, are actually assets that, like euro dollar, dollar yen, pound dollar, uh, because we are in a short-term time frame, they are typically uncorrelated ones in a very, very strong time frame. So you don't really have to worry about correlation. But assets that they have a low liquidity, such as emerging markets, dollar Turkish lira, dollar won, dollar ZAR, dollar Mexican peso, those ones, if you are a short-term trader or a scalper, they could impact your position, the cost of your position in terms of spread. Okay, so be careful. So okay, so for short-term and scalp traders, majors usually are a choice and not the emerging markets. Duration trades, for duration traders, that's not an issue, but ideally correlation should be avoided. And as I said, a good place to see correlation is either by using the correlation metrics that I have just showed you earlier. That anyway, it's a part of our expert of our premium tools, and it's for free under some terms and conditions, but you're not paying for it, and it show you in from a minute up to a week, so when you can increase and decrease the bars included in the calculation, and etc. So or if you don't like this format, for example, there are a lot of correlation metrics, and there is also a correlation heat map in Google. So there are a bunch of free widgets that you can use on the web. Now, as for the event risk, when entering a trade, ensure that you are aware of the economic calendar and that no major events will trigger your position prematurely. Okay, what time is it? Okay. The same of significant importance is not only to set goals and parameters in advance, but also to have some exit rules. Okay, also something that you need to predetermine and stick to it. It's a part of the parameters that I spoke about earlier. And I think we covered it already. Set a stop loss and don't move it if, okay, I mentioned to move it if you have a multi-target position open, or if you have if you have covered a fair enough amount of profits, then you can move it. But if those two things that I mentioned earlier are not met, then don't move it. Okay, if trends go against you and it hits your stop loss, don't worry, don't take it personal. If, of course, you have followed all the rules that we said earlier, if you have put your stop loss based on your risk and reward ratio, on your goal, by doing your technical analysis and all that. So the only reason for you to move your stop loss is in case, as I said earlier, that you have multi-target position and you want to lock some profits. Okay, if you are losing, don't even think about changing your stop loss and put it away, so with this way to have a higher exposure and to risk more of what you were initially risking. So what I mean, don't never so ever, okay, let's assume that I took I don't know, come on, I took a short position here, okay, I took a short position here, but it started to move away and higher. Don't even think about shifting your stop loss. Let's assume that, I don't know, your stop loss was, I need to find an example actually. Come on, Andrea, an example. So let's assume that you opened short position here, okay? And you saw it rebounded. Okay, £3. Oh shoot, shall I do? What shall I do? It's going against me. Okay, okay, okay. I will put my stop loss higher. I will put percent. No, don't even think about that. Leave it as it is, even if that means that you will spin stop out. Okay? You move your stop loss only if you are in profit, a sufficient profit, and you want to lock some gains. Not if the trend is against you and you are afraid and you want to and you believe that okay, okay, I will put higher in order not to be stopped out, and eventually will turn on my side. No, that's the wrong mentality, completely wrong mentality. This is how the majority of the traders lose more trades than what they initially said and what they win. That's the number one, is the discipline that Nicole was talking about earlier. The important thing is to manage your overall risk, limit your losses, but still end up every month with profit, or every day with profit, or every month with profit. So it's okay having some losing trades. Okay, it's okay. At the end, what matters is if you have met your goal. So if you have set a goal that okay, overall at the end of the day I don't want to lose more than $100. If you have 3 winning trades from the 5 that you have set, but the 2 were were lost, okay, you are still in profit at the end of the day. Right? So what matters is at the end of your day or week, depends on the goals that you have set, to be in profit or even break even. So don't change your parameters. Don't change your plan. Always set your stop loss prior entering into the trade. To break even, set profit target if trend goes up to your target. Sell the position, move stop loss on the rest of the position, and so on. Okay, and now we are nearly at the end. I'm not gonna, there are many other slides. Way to method to buy stop, sell stop, way to put your pending orders. But I think you can, we can, you can study them also yourself, because it's something that we have done several times. But anything you need, I'm here to explain further as well. So entry rules. It has to do with the technical analysis that I mentioned earlier. You might be a person that consider entry levels. Once you might be swing trader, so you enter longer at the breaking of the once the asset breaks the latest swing high or the latest swing low, or you might have spotted the head and shoulder triangle and the neckline was broken, so it was confirmed, and you can enter the position on the breakout of the headline of the neckline. Or you might be a trader that, as a rule, as an entry rule, has that I only open new positions in the morning, and the European open between 8 to 10. So find, set your entry rules based on your not psychologically, sorry, your your routine, because you might be a person that has free time between 8 and 10, okay, and because afterwards he has a second job. So this is an entry rule, okay, that you need to follow. Or you're a person that only interested on spotting candlestick patterns, and on the breakout of the candlestick patterns, then it enters the market in the opening position. So write down your entry rules and stick to it. So guys, I'm gonna call it a date. I'm gonna leave you to have a look on the pending orders per yourself. We have covered these slides regarding psychology and benefits earlier. These are just some further slides to give you some ideas, things that you can test, like how to make use of position size calculator, risk percentage calculator, multi-target calculator. These are things that could help you following following an appropriate risk and money management strategy. Okay, these are tools that you can use as well. Yes, so I would like to close the session by highlighting one more thing that you should not do, not recommended at all, and it is martingale. Don't do it. Okay, it's an extremely risky and not recommended at all. I don't know whether any one of you has tried in the past. So avoid using grid trading or martingale strategies and etc. because they are extremely risky. Yeah, what else before I call it a date? Any questions before I call it a date, by the way? I didn't notice anything. Just to clarify for those that they might not be aware of what is a martingale martingale strategy. But how can I put it in simple words? There is an illustration that I can show actually. Basically, actually there is an illustration that I can show. Let me see whether I can. Can I copy and paste it over here? No, I can't. Basically, is a strategy that involves doubling up on losing bets. So what I mean, if you're in a loss, okay, okay, I need to show you. Maybe an illustration or something before we call it a date. There is an illustration? No. Yes, no, no, yes. No, I cannot find. I cannot find an example, but it's a system in which the dollar value of your position, let's say, continually increases after losses, or the position size increases with the lowering portfolio per balance size, let's say. So it's a strategy that is based on the promise that there is only one good trade, that one good trade is needed to turn you around, to turn you into an overall profit. So it's a very, very risky system to be followed. So yeah, it's a risk seeking method of trading. So because it's based on the idea that statistically you cannot lose all the time, and that you should increase the amount allocated in your position even if they are declining in value. So yeah, that's something that is not recommended at all. So guys, that was pretty much it. Nicole Nicole said, I tried in the past. Nice for wins, horrible for losses. Yes, because you are adding on it, you are adding on it. So okay, if you win, yes, that's good, that's great, that's absolutely great. But if you lose massively. So why doing that? No, 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 no. So yeah, so guys, I'm gonna call it a date. So hopefully you enjoyed, hopefully you find it useful. We talk about a lot about emotions. So hopefully I didn't make you tired. Anything you need, I'm here to help. Myself, Marco, all the whole analysis team. So don't hesitate to contact us either via social media. Is the team, the support team is checking those messages, private uh, chat in social media, and also the email address in which my support team, myself and Marco as well, replying to those emails at webinars@agefm.com. So feel free to contact us. Thank you very much. Have a great day ahead. Take care, especially that we have this conflict in Middle East. Take care and have a great day ahead. Bye bye.